This is the Financial Thought Exchange podcast, where you get to learn from the leading thinkers in finance. I'm your host, Lotta Mobert, and my guests today are Marcos López de Prado and Vincent Zoonekynd. They are both calling in from Abu Dhabi, actually, today, and I will give a quick brief on what they do. So Marcos López de Prado teaches artificial intelligence at Cornell University College of Engineering, and he also serves as global head of quantitative R&D, so research and development, at Abu Dhabi Investment Authority. Vincent Zoonekynd is also at the Abu Dhabi Investment Authority, where he serves as quantitative research and development lead, applying statistical models and machine learning techniques to form investment decisions. Now, they're here today because they also written together a brief for us for the Research Foundation. It's called Causality and Factor Investing, a primer. So thank you, gentlemen, both for writing and for showing up and spending your time with us today.
My pleasure for having us.
It's a great contribution. I find very interesting read. So let's get an overview of we're going to be talking about factors and things that go into statistical models in finance. We'll try not to be too technical, but I hope that the audience here actually wants some technical, because I like digging into this. So maybe you can start by giving an overview of what we mean by factors in terms of things. A lot of our audience may have heard about this factors two issue, that people have found so many factors now that if you do quant investing, at some point they're not going to work anymore. That's not quite what your focus is in. So maybe you can give the context of what people might be coming from and how they should think differently about what you're targeting here.
Great. Well, thank you, Lotta, for having us. The problem of the factors zoo has been well known now for many years. It reflects the fact that there appears to be an endless number of anomalies that are being discovered by researchers. Researchers apply the standard econometric method for identifying whether certain explanatory variables have good explanatory power of the cross-section of returns. When they do that, they pay attention to identifying certain variables that appear to be statistically significant. And the problem of the factor zoo reflects the fact that there is a very large number of variables that appear to be statistically significant. There are a number of explanations as to why this happens. The one that is taking most acceptance is p-hacking. So the problem of p-hacking is that a researcher may repeat regressions for a large number of trials, and given a certain false discovery rate, eventually they will identify a discovery. But this happens to be a false discovery that results from this brute force search. So that's the problem of the factor zoo. And it's a valid explanation as to why many factors appear to fail in practice. Essentially, these are spurious discoveries, and once researchers put those factor models to the test, they do not work out of sample. It's a statistical fluke. It's a false discovery, and it doesn't work in practice. Our paper addresses a second area of concern, a second reason why factor models fail, and that is specification errors. And perhaps, Vincent, you would like to explain the problem.
Yes. So what Marcos explained is that the more tests you make, the more likely you are to make mistakes in those tests and see something where there's actually nothing. But there's another reason why you can end up with too many factors, or factors that don't work out of sample. It's because when you estimate those factors, you literally you actually estimate linear regressions. And you have to choose the variables you put in those regressions. The standard, what you find in most econometric tests is that you should put as many variables as possible, as long as they improve the results, as long as they improve the quality of the fit. If you just want to forecast something, it's actually a good advice. But if you want to explain something, if you want to understand why it works, then it's actually a bad advice, because you could end up adding variables that are not causes of what you are trying to forecast, but that are just helpful in forecasting that. And they are helpful because they are consequences of what you are trying to forecast. So you cannot really use them in practice. You cannot use them because they are decided after what you want to forecast. So there's a clear distinction to make between two things that you may want to do when you estimate a regression: either forecasting something. In this case, you can use machine learning, you can use the standard, the statistical methods. They will work great. And the other thing you may want to do is explaining why it works. And in this case, you need to pay much more attention at which variables you are putting in your model.
And it's remarkable, actually, when I read your paper, realizing like how seldom you hear people talking about this issue of there's correlation doesn't mean it's causation. If you come from the social sciences, you see a lot of that. Maybe before we dig into kind of what this means for practitioners, there are two ways in which you get the data wrong that you bring up here. So there's I'm gonna say too complicated word, right? Confounder bias. And then there's the collider bias. Confounder both start with C, so it's hard to remember which one is which, but confounder, and then there's the collider, that things collide, right? So maybe you can just start by explaining, Vincent, you can start maybe just what is the confounder bias? Like, why is that something that is important to understand and avoid,
Yes.
therefore?
Yeah. So the confounder bias is actually well understood, and people don't often make mistakes about that. A confounder. So the setup is the following: you are trying to forecast or explain something. So that's the effect from some cause. So the cause could be some financial factor, and the effect you are trying to forecast could be future returns, or if you want to explain something, the contemporaneous returns of the stock, or whatever you are looking at. A confounder would be something that is a cause of both. And it is something that you should include in your regression. Usually people don't make mistakes about that. If they have confounders in their data, they will put them in the regression because it helps the regression. So that's not really an issue. So that's the confounder. That's a common cause of the cause and the effect. The collider is the opposite. You still have the cause of the effect, but this time the collider is a consequence of both the cause and the effect. And that's something that you should not put in your regression unless you just want to forecast something. But if you want to explain why something works or where the performance of a strategy comes from, then you should not include colliders. Colliders are consequences of both the factor you are interested in and the returns you are trying to explain.
It's amazing that you say that it's actually collider bias that is the more like the common mistake people make. So if you just look at it if you come from a more non-technical field, right? You'd think that's a confounder for people who have done like econometrics or anything like that, right? May know the concept of independent variables. And that's usually like when you're trying to figure that out, because it's like, well, I need to figure out what's actually causing, what's the causal, and you find something that cannot be explained by any other means than to influence one of your independent variables and vary that independent variable. And that's still a tricky concept, right? But as you say, like that's something that a lot of people think about more. And as they go into finance and do more quantitative research, right? They actually like think about controlling for it more. I'm thinking that's the reason for it.
Yes, if you pay too much attention to confounders, you will look for confounders everywhere, and you will see confounders where there are no confounders, where you have actually colliders. So the mistake is actually confusing the two notions, or thinking that a variable is a confounder, while in fact it's a collider.
What makes the problem more difficult is that in both cases, adding confounders and colliders improves the adjusted R square, and typically reduces p-values. So the problem with colliders is twofold. Number one, controlling for colliders often changes the sign of the betas. So you end up buying what you should be selling and selling what you should be buying. So that's problem number one. And problem number two is that they are not monetizable. Why are they not monetizable? Well, a collider is an effect of the effect that we are trying to model. So by the time the collider's value is set, the effect that we're trying to monetize has already happened. So it's not possible to monetize it anymore. So that makes colliders particularly problematic. Number one, they are not monetizable. Number two, they can reverse the signs of the betas such that you end up buying what you should be selling and selling what you should be buying.
Collider is very much this. It's just important to emphasize. We're really talking about you're thinking that something cost it when it's actually a consequence of something. So it's a little bit like saying, because I bring an umbrella outside, it starts raining. And because I observe that that's what happens, right? When people bring umbrellas, but I don't understand that, no, people bring umbrellas because because they know it's raining outside.
One of my favorite examples is suppose that there is an accident on the road, and as a result of the accident on the road, and the fact that people have cell phones, they are able to warn the police, and the police comes, and you see the police deployed on the street, redirecting the traffic, etc. Now, to a bystander or someone who arrives after the accident has occurred, the first thing that they see is the police. So given that they have seen the police, they may be able to estimate, expect, predict that an accident has occurred. Now, of course, the police is only there because the accident has occurred. Now, someone who just runs some statistical analysis may think that by controlling for the police, they may be able to prevent accidents, when it's the other way around, right? If you don't want the police to show up, you just don't have accidents. So the fact that colliders are observable and improve a forecast doesn't mean that should be added to the model, even if they improve the adjusted R-square.
Right. Yeah. So fire trucks cause fires and things like that. In biology, which is complex system, you have this a lot, right? Because like in Alzheimer's research, you had the amyloid plaque theory that people just couldn't make anything out of, even though the correlation was so clear there. And it's probably because that plaque gets created as a way to protect against an inflammation or something like that is already occurring, right? And same with like when people do cholesterol analysis and say the LDH, I think it is, that is the bad cholesterol, but it's actually there to protect for something that it's going on. So, and here we have finance is obviously the kind of complex system that makes this kind of complicated. Now, I'm an economist by background, and when I think about this, I was surprised that collider bias would be the issue, because in a lot of social sciences, when you have so much time span that you're looking at, you can say, well, this happens. You have time that you can use, and then this happened afterwards. So as long as I'm looking at something that happened afterwards, usually, unless it's like something that has an expectation around it, and we can ignore that. But usually you can control it with time. Is that not something that people do in finance? Like, can't you just say like, well, I might have a collider bias. I just see what happens first and then see what the consequence of that, and just use time as my leverage in that.
Yes, so there are several situations where it's actually not possible to do that. If it's possible to do that, if you are absolutely certain that one event occurred before the other, then yes, you can do that. But it's usually not really the case. There are several reasons. First, the data that we observe in finance is usually not data about a single point in time, but data about some interval. And it's a bit more difficult to have intervals that are really distinct. And so if they are really distinct, having a good forecast that will be causal as well will not have a lot of financial use, because you would have to wait too long to make a decision. So quite often, since these are intervals, they will overlap a lot, and you don't really know what happens before and what happens after. So that's one cause. variables. Another reason is that the variables that we observe are not really the causal variables themselves, but they are proxies of the variables we are interested in. For instance, if we look at the health of a company, we don't really have a measure of the health of the company. We will have various proxies of it. And there's a delay between the actual variable that is not observed and the proxy that we observe. So even if there's a time difference between the different proxies that we look at, and for the variables that they are proxying for, you may not have that time difference, or the time difference could be in the other direction. So these are two reasons why in finance, just looking at the timestamp could be a bit misleading.
What do you
Yeah,
mean by
and let me
proxy? Okay.
You don't observe. So what you observe, what you want to look at could be, for instance, the health of a company. If a company is making good decisions or similar things, but you will only be able to look at financial ratios or other financial information that is only a proxy for the health of the company. So you have the health of the company, the size of the company, or other things that you could imagine about a company. And these are latent variables that are ill-defined as well, and you only observe some proxies that could be interpreted as whether a company is healthy, whether a company is growing, and so on.
Yes, and let me expand on something very important that Vincent has just said. The fact that X happens before Y doesn't mean that X causes Y. So even if we were able to establish that X occurs first and then Y, that doesn't mean that is a cause. This is a common misconception in the econometric method, and that it is in fact very popular in the form of what is known as grandeur causality. So in a grandeur causality model, this is a model that is it's used to determine whether X occurs before Y. And it's helpful in that respect. It's not that mathematically it's incorrect. The problem is how it's used. And the use of the word causality there is a misnomer. Granger never meant this as a causal model. What he meant is to use this approach to determine precedence. So the problem is that there is this conflation in practice between the notion of precedence and causality. So it's very useful to know that X occurs before Y. That doesn't mean that X causes Y. So that's one aspect, one part of the problem. The second part of the problem is what Vincent said, that very often financial data sets do not allow for this sort of precedence determination. The typical causal factor model is a cross-sectional model where the observations occur at the same time. So you are trying to explain the returns of the past month as a function of variables, some factors that were observed at the same time. So if a factor model is not a forecasting model, and this is where your suggestion, Lotta, which makes a lot of sense, is not being followed in practice. Not only the data sets do not allow it, but even if they allow it, it would not be enough to determine causality.
Why is that exactly? Is it in its core a expectations issue that things happen not one after the other because, just like the example with the umbrella, right? I take the umbrella first, but that's because I know it's going to rain. It rains later, but or what is there anything more to say to make a bit clear about like why the causality can work? It doesn't, the time control doesn't help you there.
Yes, so the time control doesn't help you because the variables are observed at the same time. So there are the data sets that are used in practice to derive all of these hundreds of factors they are based on observations that occur at the same time. And when you look at the typical structure of a factor model, you will observe that the subscripts of the variables do not introduce a lag. They do not introduce a time step between the y and the x's. The y and the x's are observed at the same time. So this is part of the problem is how the academia and the industry defines those factors. These are not forecasting variables. These are explanatory variables. The factor tries to explain the variability in the cross-section of returns.
So could one example there be like when you look at the income statement of a company and they report 4 times a year, then you get a snapshot of data, and you know that one may have cost the other, but they happened over the course of 3 months, and you only get like the last observation there. Similarly, if you're looking at very high frequency data, it could be similarly like within that second, you could kind of see it, but you are not able to see it because it's not practical to collect data in the interim, in an interim time, so to speak.
One way to think about this is that factor models are attribution models. A factor is not a variable that attempts to predict a return. Instead, a factor is a decomposition of the return attributed to a number of variables. So perhaps, Vincent, you would like to explain this.
Yes, so I think I mentioned that slightly earlier. There's a clear distinction between predictive models or forecasting models when we are trying to forecast something about the future. So in this case, we can use the idea that Lotte mentioned, namely using data from 2 different points in time. But we also have models that are just there to explain what is happening. And that's how factor models are actually defined. If you take any finance textbooks that explain what factor models are, you take data for a given month. You take the factor returns, you take the factor exposures, you take the stock returns for that month, everything for the same month, and you run regressions with that. So you try to explain the returns of the stocks for a given month from the financial ratios of the same stock for the same month. So it's just an explanation and not a forecast. One reason why we do that for factor models is probably that if you take the financial data for 1 month and the returns for the next month, you will have it will be very difficult to have a model that actually predicts something because the signal to noise ratio is very low. That's what you want to do if you want to invest, if you want to forecast returns. But if you want to something to explain, there's not enough information. There's much more information if everything is at the same date.
So what does this mean then for practitioners, knowing that these are the kind of mistakes you can make? I'm thinking one way to go, I'm curious to hear your thoughts, is should there be more, we're talking about a very empirical field. You get a bunch of data, you see what factors, you might do like a principal component analysis, and you just get like factor A, B, and C. It's very like data driven, right? Should the profession emphasize more theory? Like before you do anything, you should have a theory about, I believe that higher, more leverage causes higher earnings or something like that. Okay, fine. And test it on the basis more of the theory and maybe do fewer tests. This is, again, me coming from social science thinking that's kind of how it often works. That's in a way to avoid the sue, but it's also a way to say, like, you can't just explain afterwards, come up with a story why you see these correlations that you then interpret a causation for that you didn't have an interpretation for prior to running the data.
Yes. So first we need to understand the problem that we're trying to solve, and then we can adjust the tools that we apply to solving this problem. The problem of factor investing is how can we attribute certain premia to certain risks? It's an attribution problem. And an attribution problem, it's fundamentally a causal problem. So these risks are responsible for these premia. The fact that investors bear these risks implies that they only bear these risks because they are going to be rewarded. So once you understand that that factor investing is a causal problem, then the question is, how can we determine causality? How can we avoid being fooled by associations, by mere correlations, by this factor mirage, by these factors that appear to be relevant from a statistical perspective, but they are not relevant from a causal perspective? And that's where, in our paper, Vincent and I make a number of recommendations. Number one, you either start with a theory or you narrow down the possible factors through a causal discovery algorithm. So causal discovery algorithms allow you to derive directed acyclic graphs, essentially causal graphs, that are compatible with the data. And this is very helpful because it allows you to determine what variables should go into the model and what variables should not go into the model. And in our paper, Vincent and I show that when you take, for instance, the Barra factors, there are some factors that are upstream in the causal flow and other factors that are downstream in the causal flow. And those that are downstream are potential colliders, should be avoided. But the ones that are upstream are potential confounders that should be included. So once you are able to separate what variables are most likely to be causes as opposed to be colliders, that's when you can narrow down your search for a specification to a number of candidates. Once you have narrowed down that search, then you can estimate the model with more confidence that it is not severely biased. So Vincent, perhaps you would like to explain the various algorithms and how causal discovery is used in practice.
Yes. So the recommendation is probably still to start with a causal graph from domain knowledge. So if you have some prior understanding of how markets work, of how companies work, you should use that to narrow down the set of possible graphs. But after that, you can check if this is confirmed by the data. And we have a few algorithms that can do that. They don't work extremely well. So in the paper, we ran them on the Barra factors, and I was quite surprised, and the results were relatively consistent for the different markets that we applied them to. So in this case, it worked well. With other data sets, don't be surprised if you have results that are not very convincing. So I can mention some of the algorithms. The main one, the first one people tend to use is the PC algorithm. So PC are the initials of the initial authors of the paper of the algorithm. What it does is that it takes all pairs of variables and tests for independence between those pairs of variables. After that, it takes all the triplets of variables and tests for independence between two of those variables conditioned on the third, and so on with more and more variables. And at the end, the algorithm tries to reconcile all that. So since these are statistical tests, the results are not always correct. They are not all consistent. But the algorithm tries to find a directed acyclic graph, or a graph that is almost directed and acyclic, that is consistent with most of those results. So that's the PC algorithm. These are basically just a large number of conditional independence tests. There are other algorithms that you can try, such as the GES algorithm, which is a greedy search. You start with an empty graph, and then you add the edges that whose addition would improve the goodness of fit of the model the most, and you continue until you can no longer add any more edges. And there are other algorithms such as the Lingam algorithm, and with the deep learning you have actually a much more, but those deep learning algorithms tend to require much more data that would be cleaner than what we have in finance. So unless you already have a huge amount of data, you may prefer to stick with those more classical algorithms. One thing that we can add is that for some of those algorithms, you can also add constraints. So if you have some prior knowledge that you cannot have a link
Yeah.
between those two variables, or you can only have a link in one direction, you can give that to the algorithm, and that helps the algorithm find a graph that is more that is easier to interpret and more likely to be closer to the truth.
Yeah, thank you. You know, there's like two good examples of what people should be looking into if they're doing these kind of exercises. If you did miss the names of those, this is these were examples from the paper. So everybody should of course read it. It's called a case for causal factor investing. And just as we wrap up here, is there anything that we didn't cover that you really hope that your readers of these papers, probably practitioners, what should they think about after reading your paper and going into the world and starting running their models?
Yeah, let me mention two aspects. Number one, very often we hear questions like, well, if a variable increases my adjusted R-square and reduces my p-value, why wouldn't I include it? And again, the answer is a factor model is not a forecasting model. It's a causal model. And introducing a variable that improves your adjusted R-square but biases your beta such that you end up buying what you should be selling, and otherwise, that is a very bad idea from an investment perspective. So that's observation number one. Do not pursue model specifications just for the sake of improving your adjusted R-square or your p-value or even your backtest. You need to understand what risks are being rewarded, and that is the function of a causal model and a factor model. So that's observation number one. Observation number two is whenever you run a regression, it is important to disclose the causal graph that inform your choice of variables. 99.9% of the regressions that you will find in papers are essentially orphans in the sense that they are products for which you do not understand the lineage. You do not understand why the modeler has made that choice. In fact, I would say perhaps almost 100% of the papers in the factor literature present regressions without causal graphs. And our hope is that academia and practice moves into the 21st century by adopting a toolkit that is already prevalent in other areas, Lotta, as you said, in the context of biostatistics and other fields. It's very important that whenever someone presents a regression, the regression is supported with a causal graph that explains the theory behind that regression. And in that way, the reader not only observes some p-values and adjusted R-square, the reader understands what are the choices, what are the implicit assumptions that the researcher has made explicit. In this way, the conversation can go beyond whether the p-value is 1% or 2%. The conversation can be more mature and sophisticated, like, well, why would it be that this variable is a cause of this variable as opposed to be an effect? How do we know? Do you have additional evidence that explains that, for instance, the momentum factor is a confounder and not a collider? What evidence do you have for that? How could we test that assumption? And causal graphs are exceptionally valuable tools for challenging models in a way that is not just about checking p-values and adjusted R-square.
Yeah, that's helpful. Do you have anything more to add as we close out, Vincent?
So not much. So more or less in the same lines as Marcos. Investors and researchers should make their assumptions explicit. So on two levels. First, clearly state whether or clearly understand whether their models are explanatory or forecasting models. If it's an explanatory model, then they have to be causal. If it's a forecasting model, they may get away with a model that is not causal. Having a causal model may be better in terms of robustness, but that's a bit unclear. The evidence is not that clear about that. And second, if their model is supposed to explain something, and that's very important for instance, for performance attribution, if their model is supposed to explain something, there should be a causal graph that is explicit, either just a causal graph from domain knowledge that readers could challenge, or a causal graph that is also backed up by data, for instance, by one of those algorithms.
I hope our listeners and the viewers found this very helpful, and I certainly did. So thank you so much for taking your time. Thank you for being with me today.
My pleasure.
Thanks for
Thank you.
having us.
And thank you, everyone, for tuning in to the Financial Thought Exchange podcast. I've been your host, Lotta Mobert. Our guests today were Marcos López de Prado and Vincent Zoonekynd. They are authors of the Research Foundation brief, Causality and Factor Investing. So make sure you pick that up, and I will see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.